In this video, you will learn the 3 most important things to look for to have a high odds supply and demand zone trading setup. This is exactly what I personally look for my trading results that I've been trading for the past 5 years, and some of the members in the group as well also are looking for this to find their high quality, high probability trading setups when it comes to the supply and demand trading methodology. The 3 factors we will be talking today is number 1, the explosive move away, arguably the most important part. Number 2, the freshness of a supply and demand zone. And number 3, the newest thing I've been lately adding is the liquidity trap, which is super important. Make sure you guys stay tuned to the end to watch that part. All right, so starting with the aggressive move away, this is what we are looking for. I will admit, this massive push up, if you just zoom out, it is so large. This is an exaggerated example of what we are looking for. The move away does not need to be this big. We can also settle for a move away like that. What you do not want to do is call anything in here a move away. Of course, price moved from here to here. But what we did not do is move from here to here in an explosive manner. It took so long. It took days and days to get there, where to get from here to here, it took an hour, right? This isn't a 1 hour time frame. It took an hour. That is that explosive move. This represents banks and institutions and large players buying. Why? Because they are the only ones that can move the market that aggressively. Now, like I said, we don't need a massive move like that. I'm just showing you guys that is kind of what we are looking for when you open up a price chart. So just zooming out, opening up a price chart, we can move on anywhere. We are looking for those massive moves away, up and down. So we are looking for moves up for demand and moves down for supply. If you look here, you can see massive move up. You can see here, we had a nice move down, but look at the difference. So if we look at the difference here, I think we could all agree that from here to here is a massive move up. From here to here is about half the move down, another good move down. But what is the difference? The difference is from here to here. Well, I mean, I guess just measuring this big move, it only took 1, 2, pretty much 3 candles. But from here to here, it took 1, 2, 3, 4, 5, 6, 7 candles. And these are all basing candles. This is what we are looking for basing, not for supply and demand. So down here we have our basing before the massive push away. So if we were to draw this demand zone, it would look something like this. So our proximal line is right here before the explosive move away. That is what we are looking for. Massive green candles to the upside and then massive red candles to the downside for supply. Look at this. If we were to draw supply up here, which a lot of people want to do because it's just all they see, right? All they're seeing here is a high of price before price push down. And I agree. Obviously, sellers took control up here and pushed price down. But what we do not have, starting from this proximal line, is an explosive candle move down. All we have is chugging along basing candles as we push down. Nothing that represents a strong supply and demand in balance. If we go over to my supply and demand zone PDF, you can see the difference between support resistance and supply and demand. When you look over here, people like to just map out the highs and the lows of price. This is not what we want to do when trading supply and demand. If you look also for supply and demand zones, we never cut through candles as well. This is just something I wanted to kind of touch on you guys as well. We do not cut through candles with supply and demand. And even look over here. This is an image I got from Google. There's no move away here. There's absolutely no demand here. I don't know what these people are thinking or what. I don't know if somebody just changed what the real supply and demand zone trading methodology is all about, but that is not it. We do not just map out the highs and lows. We are looking for those specific moves away. If you look here, you can see we have what is a supply zone. We have clear basing and a massive move down. Look at the strong move away. If you zoom out, look at the move away, right? Compare that to this. This right here is a resistance area. Why? Because it's just a random area where price just happens to be kind of turning around. And this is actually part of the liquidity trap, which we will talk about later at the end of the video. So make sure you guys stay tuned for that. But look at the difference. Massive move away versus kind of just chugging along as we kind of pull out of it, right? So that is the difference between supply and demand and support resistance. It is a massive difference. And until you guys start to look for those massive moves away in price, you are going to continue to trade at low quality areas like this. Now, I will admit, I don't know what happened later for this zone, but even the best zones like this can absolutely fail. I just want to make sure that's very, very clear. Now, price didn't pull back for so long here, so it's really, I wouldn't really be taking the trade. I would be more likely to take this trade as we get a pullback here rather than way over here to the right. So what I need you guys to start doing is to get used to looking for these massive moves away. That is what represents a supply and demand imbalance. Because remember, guys, we are essentially trading with the banks here. We have the two parts of a zone. We have the basing, which represents basically buying or selling, whatever they want to do. They are basically creating a potential demand zone. But until we have that very explosive move, the breakout from equilibrium, we do not have a demand zone. And like I've talked about, this is the supply and demand trading PDF that comes in the membership. These are the footprints that the banks are leaving on the charts for us. And why, everyone might go, oh, how do you know you're trading with the banks? Well, because they're the only ones that can create a massive move up like that. Sure, on a penny stock or a very, very low volume stock or whatever, you can maybe move price like that if you have a decent amount of money. But in the Forex markets, the oil markets, the gold markets, trust me, guys, we don't have enough money to be making a move like that. So that indicates to us that that is a bank and an institutional buyer or seller. So for demand, we are looking for the massive moves up. And then obviously for supply, if you just look over here, here's another massive move up. For supply, we are looking for moves down. So I'm just going to show you some examples of what some decent moves down can look like. This is one here that would have been a losing setup there, depending on where your stop loss is, right? It's always nice to enter at the zone with kind of a wider stop loss. Prevents you from getting stopped out sometimes, just letting you guys know. So I'm just going to show you some examples. So this is a fantastic move away. This is like, look at the trade from that zone as well. So this is a dream move away. And sometimes I actually don't like this because it's so obvious, right? But this is like a 15 out of 10 move away. But as far as move aways that I will accept as correct, in my opinion, that's a good enough move away right there. In my opinion, this is also a good enough move away right here. Why? Because we have our basing and a move away. Compare that. So if we compare this move away to this, it's completely different, but it's still good enough. If we compare this to what is not supply and demand, so if I were to just say, for example, oh, there's a move away right here. Not really, right? Okay, if we really, really zoom in, if we scrunch our charts and we really zoom in, okay, now it's looking like a bigger move away. But when you look at the grand scheme of things, there's really nothing there. And that's kind of the biggest issue that I see, especially with some of the members who are joining my group and learning, the basics of supply and demand. That's one of the biggest things they fail to realize. There's no demand here. There's nothing here that represents demand. We need to look for those large moves away. Again, that proves to us that we are trading with the banks and the institutions. So yeah, what you also don't want to see is hesitation immediately after, the move away. You can still trade these zones. So for example, here, this right here, if I can just draw the zone properly. So the move away is not bad initially. We hesitated here. It's not terrible. I would like to see an overall move away. So again, we are looking for the aggressive, sharp move up, but also we want to see price really retrace. And if you look here, it's a great example of how price barely hit the zone, came back in and reacted off of it perfectly. So yeah, and then we eventually ended up breaking it. So just going to show you guys some more examples of some decent moves away. That is a good move away. Up here, compare these two right here. Not really the same. And then some people want to draw something like this, and they make their zone very large. And you can do that, but it just kind of looks weird in that situation. So hopefully you guys are starting to understand the importance of that move away. We want to avoid drawing those super tiny zones with the super tiny moves away. If I'm just looking at a price chart here, I don't really see too much here that represents a supply and demand imbalance. Again, I see this supply up here. I guess I see a supply zone right there as well because of the move away. But I just don't notice anything in here. And I can quickly tell you there's no demand in here. But a lot of the times people will, especially beginners, they'll really start to zoom in and be like, oh, okay, there's a demand zone here, right? I'm really zoomed in and it looks like a demand zone to me. And then you kind of zoom out and it's like, it's not really, there's not a lot going on there. I mean, and this trade worked out beautifully, but it's just not a trade that I would have taken because I am always trying to make sure that we have that great imbalance, and preferably as well when in an imbalance, we don't want to see wicks coming out of the imbalance. So let's say this is our green candle right here, and we have a wick like this. I don't love that because these wicks basically tell us that this is kind of a basing candle. So what I would prefer is really small wicks or none at all. That's going to represent the strongest imbalance because the wicks indicate indecision. So just for example over here, look at this massive red candle. It's only a tiny wick here. There's no wick there. Same thing with this candle here. There's really no wicks. So we're looking for that Marizobu candle. I kind of forget what it's called. You guys can Google it. Doesn't really matter. It's just a name for the candle. So we're basically looking for those Marizobu candles or whatever they're called, those strong moves away. Once you start doing that, again, you will only be on the right path to success. All right, now we are going to discuss the freshness of a supply and demand zone. This is extremely important. Now, I will say I never trade at tested zones. Now, let me tell you what a tested zone is. First, let's discuss kind of the core concept, the logic behind a supply and demand zone. If you guys want access to this PDF to help with your trading, it comes with the Diamond membership, which also comes with daily market breakdown videos, which are forecasts that I release daily, supply and demand video lessons to help you aid in your supply and demand trading, Sunday Zoom sessions where we discuss strategy, and Sunday forecast, and much more. So check it out. Links are in the description to the Diamond membership if you want access to this PDF and everything that I just mentioned. So the return to the zone, the unfilled orders, the logic behind supply and demand, which I touched on earlier, is that the banks are the ones creating this demand zone or the supply zone. They push price so high up that price couldn't return to the zone. The idea is, let's say right here, they had 1 million orders to fill at that zone. Let's say they only got 500,000 filled at that zone. Why? Well, because price pushed up. There wasn't enough sellers to fill all 1 million. The logic behind the supply and demand zone trading is that on the return to that zone, or maybe they're even actually pushing price down to the zone, it is possible that the rest of the 500K orders are still sitting there, and the idea is that when price comes back to that area where price exploded from, the rest of the orders are going to be filled, and that is where we are buying. We are buying on the pullback. That is where the leftover buy orders are sitting at. Now, I've touched about it on my full course video as well here on YouTube. I'm not saying the banks are creating this on purpose. I'm not saying they're saying, oh, we're going to base price up here and then push up and then return it and then we're going to push price up. I am not saying that at all. I'm just saying this is an accidental thing that they are doing on the charts. Not even accidental. It's just that is just objectively what happens. Nobody can sit here and tell me this is created by Jimmy with a $100 Forex account in his basement. So that is not what is happening. So that is the logic, right? There's leftover buy orders sitting at that demand zone, and that is why we are buying on the return. We are not predicting this move up. We are simply buying on the return, or for shorting, we are selling on the return. So we need to make sure the zone is fresh, because so remember what I just said. Remember this entire lesson as we go over to a real price chart. So right here, we have our demand zone. We identified the massive move away. Reminder, this is an extremely good example. They're not always going to look like this, but price never came back and hit it. Even here, the zone is still fresh, so it is still a good zone. The leftover buy orders are potentially still sitting here. Now, as we move along in price really came in and tested it. All of these buy orders, in my opinion, have now been filled. And in my opinion, there's probably a lot even filled here that were not even filled before. So it might have even been that there was 1 million orders here and only like 100,000 got filled. That's why price came back to this area so many times. But what I will say is as soon as price comes in and hits this zone, let's say I miss this trade, it's whatever, price comes back in, I am not taking this on the second test. Many traders will take this on the second test. I will never do that. And look, it was a winning trade, but I am not going to sit here and pretend, oh yeah, this is one of those weird times where I would have taken the second test. I have never taken a tested zone like this. The only time I would ever consider taking a tested zone is, so this is a 1 hour chart. Let's say our higher time frame, which is the daily chart. Let's say we had a beautiful daily upward trend. We are pulling back into a daily area of demand, and we have this 1 hour demand zone sitting perfectly inside the daily demand. But then price comes in, we just barely wick it, and it goes out. Okay, you could justify maybe taking a second test with an entry just right below where price previously pushed in. I have seen this work out many times from my personal experience. So that is the only time I would consider it. And even then, I don't even really do it. So it just goes to show you how strict my rules are when it comes to, a zone being tested. Because again, the logic behind it, if price comes back to it multiple times, well, those leftover buy orders, they're gone now because they're filled. But you can kind of justify it if price comes in and wicks it like this wick right here. Let's say this wick just barely touched it like that. Then, okay, maybe that wick only filled an extra 100,000 buy orders. And then maybe price is going to come back in and fill the rest of the 100,000. And then boom, we push out. That is kind of the logic. So if price comes in like this is a very deep test. I really don't like this. If I was ever going to trade at a tested zone, it definitely would not be this. Not only did we push 80% of the way into the zone, we spent 1, 2, 3, 4, 5 candles here before pushing out. So a lot of these orders are being filled. We have to think about price like that as a story. The orders are being filled here. So trading it on a second test is very low odds. But clearly there was so much demand here that price was able to do this and react off of it multiple times. Now, a lot of the reason people want to trade tested zones like this is because of their support and resistance mindset. Support and resistance, you are looking for multiple touches of an area. It just makes the area stronger apparently. But for supply and demand, it's opposite based on the logic that I was telling you guys about with the orders and the leftover buy and sell orders. So hopefully this is starting to make sense. Remember guys, any questions at all, do not hesitate to ask. And if you guys are enjoying this video, make sure you hit that like button and subscribe, and check out my full trading tips playlist here on YouTube if you want more free videos. So if you want to trade at tested zones, like you can even trade at a tested zone like this. You could have traded at this tested zone. I am never going to say, something's right or something is 100% wrong. But what I would do in this instance, if I was going to trade at this tested zone like this, what I would be doing is looking for confirmation on an entry time frame. So for this example, this is a 1 hour chart. So if price was coming back in for the second test, I would be on a 5-minute time frame looking for confirmation, which means I'm on my 5-minute chart waiting for price to come back. I'm waiting for opposing trend lines to be removed, demand zones on the 5-minute chart to be created to look for longs off of, to basically confirm that price is going to go up. That is just going to increase your odds of not getting stopped out. Me personally, I am never going to trade at a tested zone. I've seen it fail so many times that I cannot get it out of my head. So I am just personally not going to do that. So the concept is very simple. Price can even come all the way back down to here, just miss it, and then push out, and you don't have to call this in control. Now, let's say price did something like this, because I've seen this happen so many times. There's actually a great example on the euro as we speak. But if you just look here, so I'm just going to pretend that this line is a wick, something like this. So a lot of times you'll see something like this. Oops, that's actually not what I wanted to do. Something like that. So a lot of times you'll see something like this, and you'll be like, oh, this zone was just wicked beautifully and price pushed out. So the zone's tested now. But then when you really zoom in, right? So I'm really zooming in here. Crazy zoom. I don't even know if you guys can see this, but price didn't actually hit the zone here. But, I can be pretty lenient. I think it's safe to say that the zone is tested. I don't care if it's off by a little bit of a hair. look at it. It looks tested to me. Now, this is, like I was pointing out earlier, it's really not the best. It's not the worst test ever. You can almost justify taking it again if you really, really want a little bit lower using confirmation or whatever. But this is vastly different than getting something like this where we have, a body candles closing in the zone, right? Look at the difference, right? And all I'm saying is if you zoom in and price didn't actually hit the zone, but just looking like this and it did, you can feel safe to call it tested, especially since you could justify maybe making the zone a little bit bigger. And then at that point, look, the zone is very, very tested. So at that point, I would feel safe to just call it tested. Sometimes it's just better to be safe than sorry. So that's the next thing I want you guys to start doing this week when you start trading. The first thing, look for the explosive moves away. The second thing is only trade at fresh, untested supply and demand zones. All right, finally, the third thing, and arguably one of the most important things that I look for now, just to increase the odds of the zone working out. Not every zone I take has a liquidity trap before the zone, guys, but it is my favorite odds booster in my opinion. So what is a liquidity trap? I've talked about it many times before. Basically, to keep it simple, it is when we have a support and resistance area right before a supply and demand zone. And what this represents is support and resistance area traders trading at the test of the zone. And where are their stop losses? Well, it's below the support area, and that is right as we contact our demand zone. So essentially, we are taking the opposite side of the retail traders, which is going to be pretty good. I know that I'm a retail trader, so don't get mad at me saying, oh, you're a retail trader too. I get that. I'm just saying it increases the odds of being on the right side of the trade. We want to be trading with the banks and against retail. So not only can we try to identify the banks by their large pushes up, we can also identify where retail traders are going to be by identifying the support and resistance area. So if you look here, this is a fantastic a fantastic example. We didn't really get the setup here. And look, guys, just a little extra tip. When price takes this long to retrace to your zone, I don't even know if price hit it. Not going to be the highest odds situation. I will tell you that. So, what is a liquidity trap? Well, if you look here, we have our demand zone. Why? Because that explosive move away, price came down, we almost hit it, and then we pushed out. This is a clear area of support where we have a demand zone right before it. Now, this isn't the best liquidity trap I've ever seen. What I would have liked to seen is obviously this initial move to create the initial basing. But then what I would really want to see after that is a push down, react off of it again, and even a third time. From my experience, 3 touches, obvious touches as well, seems to be the best situation where we come back. We create it, we come back in for 2 touches. Sorry, so not 3 touches. The creation of the support and then 2 more touches before eventually rolling over to our demand zone and getting the trade. This is a very high odds booster in my opinion. The win rate for these liquidity trap setups is very, very high. I will say that. So it is definitely something you want to start back testing and getting used to identifying this. It's something that I never really realized before. I actually used to think for some reason that when price based out right before your zone, it wasn't a good thing. And I don't know why. Maybe it was just some dogmatic thing I was taught. I'm not really sure. But even if let's say price came back down and then we just hit it, we didn't even react off it, that's still fine in that situation. Now, what I wouldn't want to see is, let's say price went all the way over here and then we really pushed up over here, then we came back in. At that point, price has pushed so far away from this initial basing. I want to see proof that it's a liquidity trap first to really call it a liquidity trap. I still might take the trade, but I might not call that a liquidity trap because over here, traders might not be seeing this support area over here. But, if you just look over here, if price created the basing, then came back into it right away, it's a obvious support area because people can see it. But when price goes so far away, I like to see a second tap off the zone to really confirm that it is a liquidity trap, especially, when price pushes so far away. And look, this just makes logical sense in my opinion. Now, what I don't want to see, and I've seen some of the members of my group do this as well. Let's say they have their zone, and then price pushes out of their zone, then we just this is a bad example. Let's say price pushes out of their zone, and just like a small wick like this. So it's just a wick. I don't call a wick a liquidity trap in my opinion. Now, if it was like multiple wicks, right? Multiple wicks. Oh, this is a bad example as well. Sorry, guys. So let's say it was multiple wicks like that near the zone. Then okay, there's so many wicks here that clearly there's so much demand in this general area that price keeps wicking out of here. So in that instance, the wicks are fine, but I don't want to see just one wick as a liquidity trap. I like to see structured basing, like in this example. So we actually have a wick, which is great, and structure basing. So that's what we prefer when trading a liquidity trap. And then obviously for supply, it is just a little bit different. So this is actually a great example. This was a losing trade. But if you look here, so we had a supply zone type thing here. This could justify as a liquidity trap, in my opinion, like this right here. It's just not as obvious, right? Like, are you really... So I think everybody in the world who understands trading in support resistance, everybody's going to call this support. 100%. Just like everybody's going to call this support. It's really demand, but I'm going to call it demand. But it is also support, right? Duh. But is everybody going to call this up here, you know, resistance, at least on this time frame? I mean, maybe. It is some sort of liquidity trap. It is some sort of resistance here. It's just not as obvious. What I would have liked to see is this, and then a massive push down, right? It's more of an obvious liquidity trap. One thing I like to do in my trading, whether it's trend lines or supply and demand zones or whatever, I like it to be very, very obvious. Like so for back to the original thing, the move away has got to be obvious. The move away has got to be obvious. The basing has to be obvious. The support and resistance liquidity traps have to be obvious as well. So this is just another great example here. If there was a supply zone right above this, so let's say we had a supply level sitting right here, this would be a perfect situation, right? And obviously it would have been a losing trade, but there was no supply zone here. Anyways, I'm just kind of showing you guys what I like to see for a clear resistance area and for what a liquidity trap area is. So it is just the opposite for supply. So for supply, we are looking for resistance before a zone. For demand, we are looking for support before a zone. And remember, support and resistance are not the same, guys. I cannot stress that enough. That is like the biggest misconception when it comes to supply and demand trading. So keep all of these tips in mind, guys. If you have to pick one of them, it's going to be the explosive move away. Okay, because you go on YouTube, you type in supply and demand zone trading, and they're calling this demand in here and this demand in here, and it's like it's not at all. And I would agree with everybody. Obviously, supply and demand is everywhere. Every single candle represents supply and demand. But if you are not looking for these explosive moves away, you're not going to be trading at those massive big bank imbalances. And then adding in the fact that you're only trading at tested zones, adding in the fact that maybe you are going to be trading against retail, identifying clear areas of support and resistance to trade below and above, your trading success is just going to go up. And one thing I've always mentioned to members and just everybody as well is, okay, these gurus on YouTube and Instagram that are like, oh, I made 100 grand trading in the last 4 days for my $10,000 account. They're lying. I'm just going to go ahead and say it. They're lying. And you need to have reasonable expectations. I don't go out golfing expecting to beat Tiger Woods' best score. I just simply don't. I'm not an idiot, so I don't do that. So you also have to have reasonable expectations when it comes to trading. So just adding in this liquidity trap area into your strategy, or adding in, maybe you were trading at tested zones and you didn't know that. Maybe you get rid of that. Maybe that extra little thing that you found in this video or in my course or in the PDF or whatever, maybe that extra little thing is going to take you from being a break-even trader to being a profitable trader. Just that one little thing, because like I was saying, the expectations that traders have is they're going to turn their $500 into 500 grand in 30 days trading. It is impossible, pretty much, unless you are taking massive gambles. So have reasonable expectations and understand that adding in the explosive move away, adding in only trading at fresh zones, adding in the liquidity trap before the zones might take you to the next level. Because the edge you are going to have in trading isn't going to be massive, guys. I'm just telling you that right now. Making anything above 8 to 10% a year is absolutely incredible. When you take hundreds of trades a year, it is amazing, and you should be proud of yourself. aiming for like 30-40% is completely reasonable, and you can do it. All you got to do is risk more. So what I'm saying is just a simple tweak like this can really turn you from a break-even trader to a profitable trader. It might turn you from a losing trader to a break-even trader, and then you need to keep learning and adding on. So I encourage everybody to start to back test this. Look for the explosive moves away, only trade at fresh zones, look for the liquidity traps before the zones, and maybe you guys can even identify, maybe there's like chart patterns before a zone, flag patterns before a zone. Maybe that works good as well. There's other types of liquidity traps that you guys can also be looking for. So with that being said, I appreciate every single one of you for watching this video. If it helped, let me know in the comments down below. Leave me a comment. Say, hey Kev, love the video. Much appreciated. If it didn't, let me know as well. Maybe something I could do better next time. Check out my trading tips playlist. I have my full course on YouTube here. And of course, if you want to join the Diamond membership, that is where I really take the time with the members to help them learn with the Sunday Zoom sessions, the daily market breakdown videos. If you want to watch my forecast on the Forex markets every single day, that is also included. And then, of course, the PDF that you guys were seeing in here as well comes with that as well for lifetime access. So anyway, guys, hit that like button, subscribe, and I will see you in the next video.